Well, on Tuesday, President Biden and House Speaker Kevin McCarthy reached an agreement on the debt ceiling. Today, that agreement is being voted on by the House. We're joined now by TwinFocus co-founder and managing partner Paul Karger, who believes that this latest debt ceiling agreement is just another way to delay the issue until the 2024 presidential election. Thank you for joining me this morning. So break down that base case. I mean, a lot of people didn't think that we'd end up sort of in this free fall default situation, but you seem to think this is more about political posturing than really making any serious decision on the debt ceiling.
Absolutely, Rachelle. Great to be with you again. As you noted, Biden and Speaker McCarthy did come up with a plan, as we anticipated. We were calling for this a few weeks ago, and it seemed the market was too. The market really had the playbook on this debt ceiling. Listen, it was posturing on both sides. No side came out completely happy. Kind of, in the words of words of Larry David, kind of a great compromise where both sides are a little bit unhappy. But truly, all they do is kick the can down the road to, a few years out, just after the next presidential cycle. This really doesn't address the budget deficit. It's really just focused on the discretionary spending over the next few years.
And so why do you think we're still seeing the jitters in the market at the moment? I mean, no one really expected a default here, but we're still seeing, some selling action today.
Yeah, the market's down, less than 1% or so. I think a lot of it, really has to do with some of the slowdown that we're seeing. China's off a bit. China's not as strong as expected coming out of the COVID zero policies. And, Europe is still experiencing this industrial slump. So, again, the world continues to flirt with some kind of recession, whether or not we have a full blown recession or some kind of mild recession or some kind of recession in certain sectors is still remain to be seen. But I think the market is concerned about the weakness in the economy.
And that did seem to offset some of the confidence that they at least saw from the FOMC meetings that did at least signal that at some point the Fed is going to be ready to sort of hit the pause button there. What is your view in terms of the outlook here for markets and what they're pricing in for what the Fed is going to do?
Well, as we all know, markets are really dependent on the direction of interest rates at this point. There seems to be some indication that the Fed has reached some kind of terminal value. I think it's north of 60%. The market's pricing in some type of rate hike, maybe 25 basis points at the next meeting, less so in the July FOMC meeting. As they've said, it continues to be data dependent and data driven. We do believe we're reaching some terminal value. We don't think we're going to see some rapid decline or cuts in rates anytime soon. The world still tends to grapple with this inflationary issue. You're seeing some disinflation, on the commodity front. As we know, commodities are off significantly, nat gas in Europe, for example. Which should give some reprieve to consumers and corporate. But remains to be seen, dependent on the direction of interest rates.
And do you think deflation concerns now then are perhaps outpacing what we're seeing in terms of inflation worries?
Certainly on the commodity side, we're not seeing any relief in wages. And, as your prior commentary reported, we're certainly not seeing much relief on rents, which are, both big determinants in the inflation number. It remains to be seen. Who knows? We could see wages pull back a bit if we do slip into a recession. At this point, we're predicting perhaps a light recession, or maybe we're able to escape the recession. There's a lot of liquidity out there able to address a lot of these concerns in the credit markets, but I do think we'll get through it.
And for clients who are looking at equity markets and looking for opportunities at the moment, especially seeing the tear that it's been on so far this year, how are you advising them?
On the equity markets, we tend to be more conservative. We continue to focus on utilities and consumer staples, goods that are, stocks that are more focused on cash flow. We do like credit markets, as has been, extremely discussed in the popular press. Credit is really appealing here. The banks have pulled back in lending, and there's a big gap. And, from corporate to real estate, we don't necessarily see a widespread fallout in commercial real estate, certainly some sectors, office in New York and San Francisco and so on. But we think there's a lot of opportunity for credit, as you previewed on your show here.
Well, there you go. Some places to look indeed. A big thank you there to Paul Karger, TwinFocus co-founder and managing partner. Thank you for joining us this morning.